it's happening. Foreign powers are walking away from U.S. debt. China has aggressively slashed its Treasury holdings. Japan, once America's most dependable bond buyer, is quietly pulling back. Global banks are dumping Treasuries. And now, the big question looms. Who's left to buy? For decades, the U.S. financed its economy by issuing debt, and the world happily bought in. But that era may be ending. As bond yields surge and the dollar shows signs of strain, the world is signaling a dangerous shift. They no longer see American debt as the safe bet it once was. And if no one's left to buy the debt, what happens to the economy that depends on selling it? For decades, U.S. government debt was considered the safest asset on Earth. Nations bought trillions in U.S. treasuries to stabilize their currencies, hedge against risk, and build reserves. It wasn't just about profit. It was about trust. Trust in the U.S. dollar. Trust in the U.S. economy. Trust that America would always pay its bills. That trust is now cracking. The U.S. national debt recently surpassed $34 trillion, 0 cents, and the interest alone is approaching $1 trillion, 0 cents per year. Meanwhile, political gridlock in Washington, repeated debt ceiling showdowns, and rising inflation have made global investors uneasy. At the same time, the Federal Reserve is no longer a major buyer, and inflationary pressures have made bonds less attractive. Add in rising geopolitical tensions, especially with China, and a strong dollar that punishes foreign holders. And suddenly, what used to be a safe haven is being treated as a risk. That's why central banks, sovereign wealth funds, and global lenders are rethinking their strategy. The big worry? If the world stops funding America's borrowing, the U.S. may be forced to raise rates even higher, slash spending, or print more money. And none of those choices come without pain. China's retreat from U.S. treasuries isn't accidental. It's a deliberate, calculated strategy. Once the second-largest foreign holder of U.S. debt, China has been quietly slashing its treasury holdings over the past several years. As of the latest data, its U.S. debt portfolio has dropped below $800 billion, 0 cents, the lowest in over a decade. Why? There are several reasons, and none are good news for Washington. First, China wants to reduce its dependence on the U.S. dollar. With rising tensions over Taiwan, technology bans, and trade restrictions, Beijing sees U.S. debt as a potential geopolitical weapon that could be turned against it. Second, China is rapidly investing in its digital yuan infrastructure, building a parallel financial system that bypasses the U.S.-led SWIFT network. That shift requires rebalancing its reserves and cutting dollar exposure. Third, with rising U.S. interest rates, China faces massive unrealized losses on its existing holdings. Selling off treasuries now is a way to cut those risks and rebalance toward commodities, gold, and regional investments. This is not a panic move. It's strategic de-dollarization, and it's picking up speed. And if China, the world's second-largest economy, is exiting, who's brave enough to stay in? While China's retreat is loud and strategic, Japan's exit is quiet, but just as alarming. For decades, Japan was the largest foreign holder of U.S. debt, seen as America's most reliable financial ally. But in the past year, Japan has steadily reduced its holdings, down nearly $250 billion, 0 cents, and still falling. So, why is Japan backing away? It starts with domestic pressure. Japan's own government is facing rising debt, a weakening yen, and growing costs to support its aging population. To stabilize its economy, the Bank of Japan has had to defend the yen, which means selling off U.S. Treasuries and buying yen to stop currency collapse. At the same time, rising U.S. interest rates have made holding Treasuries more volatile. Like China, Japan is facing unrealized losses on billions in bonds. Selling now is about protecting national reserves and reducing exposure to U.S. political risk. Unlike China, Japan isn't making a statement. It's simply prioritizing survival. But that may be even more troubling, because if your most loyal buyer, your oldest financial friend, is no longer buying, it suggests something deeper. Faith in America's fiscal discipline is fading. It's not just nations pulling back. Global banks, hedge funds, and sovereign wealth funds are also quietly dumping U.S. debt, and their reasons are purely financial. For years, U.S. Treasuries were the gold standard of safe investments. But now, rising interest rates and increased fiscal instability have turned those once reliable assets into a high-risk proposition. Many sovereign funds in the Middle East and Asia are now shifting their reserves into diversified assets: gold, oil, infrastructure, and even Chinese and Indian bonds. Holding U.S. debt today means accepting higher volatility, weaker returns, and the risk of policy-driven defaults or shutdowns. Major banks are also adjusting. J.P. Morgan, HSBC, and others have reduced exposure to long-term treasuries, citing duration risk and uncertainty in U.S. fiscal policy. Even pension funds are hedging their positions. The global message is clear. The world no longer sees U.S. debt as untouchable. And if private institutions are scaling back, it puts even more pressure on the U.S. government to find buyers, or face the possibility of soaring interest rates, funding gaps, or an eventual monetary crisis. The exit isn't loud, it's quiet. But it's happening. With China pulling back, Japan retreating, and global institutions stepping aside, the question becomes unavoidable. Who's left to buy U.S. debt? The U.S. government depends on constant borrowing to fund its military, infrastructure, healthcare, and interest payments. Without foreign buyers, the burden shifts inward to domestic investors, banks, and ultimately, the Federal Reserve. But that creates new risks. Domestic banks are already under pressure from tighter regulations, higher rates, and reduced liquidity. Pension funds and insurers have limited capacity to absorb more long-term bonds, especially in a volatile rate environment. That leaves the Federal Reserve as the buyer of last resort. But when the Fed buys government debt, it expands its balance sheet, injecting more money into the system, which can drive inflation and further weaken the dollar. The U.S. could raise interest rates to attract new buyers, but that risks triggering a recession. Or it could offer shorter-term bonds at higher yields, but that only kicks the can down the road. The reality is stark. Without global demand, borrowing becomes more expensive. And if the U.S. has to fund itself in a world that no longer trusts its debt, it's not just a financial problem. It's a structural shift in global power. The retreat from U.S. debt is more than a technical finance story. It has real, far-reaching consequences for the entire American economy. First, as demand for treasuries falls, the government must offer higher interest rates to attract buyers. That means the cost of borrowing surges, not just for the government, but for businesses, mortgages, and credit cards. Everything becomes more expensive. Second, a shrinking buyer base weakens confidence in the dollar itself. If global markets believe America is struggling to fund its debt, the dollar could begin to lose its status as the world's reserve currency. That would drive up the cost of imports, fuel inflation, and reduce the U.S. ability to project economic power. Third, investor sentiment starts to crack. Markets fear instability. Foreign capital looks elsewhere. And if the Fed is forced to step in and buy more debt, it could spark new waves of inflation, undoing years of tightening. All of this creates a dangerous feedback loop. Less trust, higher costs, weaker growth, even less trust. America's economy is still strong, but its foundation is built on borrowed money. And now, that foundation is being tested like never before. For years, analysts warned of a potential U.S. debt crisis. But few imagined the exodus would begin this soon. With China and Japan stepping away, global banks retreating, and borrowing costs rising, the warning signs are no longer theoretical. They're happening in real time. And the question now isn't if the U.S. faces a debt reckoning, it's how soon. The U.S. has long relied on the world's trust that its bonds were safe, its currency stable, and its politics predictable. But now, faith is fading. Political polarization, ballooning deficits, and repeated debt ceiling standoffs have left international investors questioning whether America can continue to lead the global financial system. If confidence breaks completely, the consequences could be severe. A falling dollar, surging interest rates, shrinking credit, inflation, and a rapid decline in U.S. economic dominance. Washington still has time to fix it by restoring fiscal discipline, stabilizing policy, and rebuilding trust. But the window is closing. The world is watching. The buyers are walking. And the U.S. is running out of lifelines.